What's up, YouTube? Today I wanted to try something a little different and go for a video that has no edits and more like a podcast style video because there's some things that I have on my mind where I would like to talk about the general market and overall sentiment, but typically I usually don't put that kind of information out there. I know there's a lot of people already doing it, and nowadays, now that I have a little bit more time, I guess I'm thinking, why not share my own perspective on what I think is going to happen and why. So, with the economy the way it is, and a lot of the reason why I got into stacking, some of you might have seen my why I collect silver video. And in that video, I go and explain how I've lost some money over the years and how I've gained back some money over the years. But overall, I've continued to make some progress with my investing strategies because in the early days, it just kept getting wiped out over and over. And I've seen people get wiped out over and over. So these days, I'm a lot more conservative in the way I approach my investments. And for those of you who are lucky enough to be able to just put everything in one thing, one or two things, more power to you, man. I really admire that skill. I don't have that type of intuition. For me, diversification and hedging my bets has been the best way to work out for me. And mainly because you never know when things go wrong. And so far, it's worked out where when I plan for the worst, then I'm more protected and ready for than when it just kind of comes out of nowhere and I don't expect it. And that's happened on a couple of times. That's happened a couple of times to me already. One of the first times, or I shouldn't say one of the first, but one time was when I first started stacking. I didn't really gauge how much I was spending, and I had overspent. And I think a lot of people who just get started into stacking end up doing this. You have a lot of discretionary funds that are just kind of sitting around and you're looking to buy stuff, or you got a new kind of a new hobby, and from there you just start spending everything that you can on it. Well, at the same time, or I should say not at the same time, but a year before, I had just purchased a property and I was trying to put some money away, and I thought that by putting this money away, that if something were to happen, I would be able to get it back. Well, fast forward a year later, my first bill with property tax came through, and bam, I was not ready. So I had to liquidate a bunch of it at, it wasn't really a big loss, but it was a little bit of a loss. But I did learn the importance of flipping at that point, where cycling the silver and the gold was going to be the better option in order to make sure that I always had liquidity available. So that's one of the things where, or I should say, liquidity is a really important factor with any sort of investment, and knowing the type of liquidity that each asset has is just as important. When I say the type of liquidity, it's the speed you can get rid of that asset and exchange it for something that's usable like fiat, or just, I guess, the fungibility of it, how fast it'll take you to switch it out for what you actually want to get. So that experience anyways taught me that I had overspent and I had put too much in at that one particular time. Same again happened a couple of years later when I got into crypto, and what ended up happening was it had gone up pretty quickly and I was just really stressed out. And I think a lot of people ended up like this because when it goes up really fast and all of a sudden you have a good amount of money and it's just not doing anything, or you just get frustrated or worried. So I ended up pulling money off the table because I was too stressed out. And that's kind of another lesson that I learned, is that if you're worried about it, then you probably have too much in it if you're constantly worried about your investment. So this is one of the most important sayings in all types of investments, is never risk more than you are willing to lose. And that's just food for thought. It's just what words to live by. It's just always invest what you think you can lose. But sometimes, the risk takers out there are going to love to just risk it all for just the big win. And hey, when opportunity knocks, sometimes that's what you need to do, but take it on a case by case basis. You got to learn when to hold them, when to fold them, and when to switch them out. So it's a difficult game. Some people are way better than others at it. I'm all right. I'm not the best at it. But hey, I'm doing what works for me. Try to find what works for you. Because for me, some things don't work very well, and I have to adjust according to that. Well, anyway, enough about that little ramble. But when it comes to overall market, I'm generally thinking that the U.S. debt is one of my biggest concerns over the years, and that's one of the biggest reasons why I got into stacking a little bit more aggressively than before. And it has to do with that really ballooning rise in national deficit. We're not slowing down, we're continuing to spend more, and the dollar is continually getting inflated. So for a while, I thought that there might be a slowdown in how fast the dollar would inflate, or at least government spending would go. But instead of declining government spending, what we're seeing is increased government spending and increased tax cuts for the people that don't really need it. But what I'm hoping for is that somehow, some way, that money is going to end up trickling down at some point, because it really needs to, in order to build a strong middle class and build up the consumer base. Because realistically, the U.S. economy is built on consumerism, and it's an engine. Eventually, when you run out of fuel, then it starts to slow down and bog down. And I think we're getting to the point where it's possible that the dollar might start to inflate. But of course, there's also a very famous saying that the markets can remain irrational longer than you can remain solvent. So trying to bet against that isn't the best thing to do, which is why I stack on a consistent basis. Because in addition to the PMs, like I said, once I found out PMs was going to be so-so after the spotting and building up a good foundation stack, and I decided to go into crypto for the same reason that I did the PMs, and to also add some depth to my portfolio, because I mentioned that I had purchased some property where I live, and this property is a really low liquidity type of asset, because it takes a long time to sell, and there's a lot of restrictions in order to get the cash into the account, and it takes a lot of time. So PMs are a little bit quicker, but still slow, and crypto is even faster, but you have to take it with the volatility. So each one has its own pro and con, and it's up to you to balance out which is right for your portfolio or not. And for a lot of people in the stacking community, it's PMs only. And I really think that you might be doing yourself a disservice. And I only say that to the younger folks, because there's really a lot of growth that you're missing in terms of the stocks and appreciation and just overall growth of your money. Because when you have physical is good because you hold it, you own it. But when you own a stock, someone is working for you rather than you working for someone else. So it's your money working for you. It's those big CEOs that are working for you to reward the shareholders. So keep in mind, they want to do what's in their best interest. And their best interest is to make themselves richer. And this is why working with a stock market is better for younger folks. And don't take this as financial advice. This is just my opinion. That's worked well for me because having an asset that just does nothing and you're just hoping that it beats the dollar on inflation is not really the best overall strategy. It's a decent strategy by itself because you just have one target, and that's just to beat inflation. But there's more depth to everything, to the world in general. So I think that spreading yourself around is the best way to go. And the way I was able to first afford that property was through the stock market and raising enough funds through different investing techniques. And I probably would have done well if I just stayed in the market and not done PMs altogether, but what can you do? It's a road that I crossed, and I added it to the portfolio. And I mean, it's not like I still don't add stocks. It's just I divvied it up a little bit and allocated some funds specifically for saving, to make sure, just in case the stock market does go down, that I don't get completely wiped out, because that happens to people. And a lot of people who are afraid of that are the ones who are stacking only. So I can totally see why one would only want to stack, especially if you're in your later years and you just can't afford the risk of losing your principal or your what you've worked so hard to earn. But the younger folks, you guys can take that cash, you can put it and risk it a little bit more, and hopefully end up with a better life when later down the line. Because trying to save, nobody, as I say, very few people got rich saving to wealth. But well, maybe I didn't say that right, but I think the saying goes, nobody worked themselves rich. That's not true, because people do work for people that are rich, especially these days in .com. You can get very wealthy working for someone else. But general rule of thought is it's very difficult to save your way to become rich. It can be done, but work to save to wealth is the more difficult path. And when you add stocks, you can add a separate way, a separate type of income stream to help assist the way you work. But of course, timing is always a part of everything. And the younger you are, the more time you have. So anyway, I don't want this to get too long. It's already a bit rambly. So please let me know what you think. Please comment, like, and subscribe. Bye.